Did India just agree to a $500 billion bill to stay in America's good books? Or did Narendra Modi quietly dodge an economic crisis while giving up far less than it appears? The new US-India trade deal has been called a masterstroke, a humiliation, even a geopolitical arm twist. But here's the truth. This deal is not about tariffs. It's about leverage. And if you really want to know who won, Trump or Modi, you have to look past the headlines and into the fine print. Let's break it down. Before this agreement, Indian exports to the US were being hit with tariffs of up to 50%. 50%. That's not a trade dispute. That's economic suffocation. Half of that tariff, 25%, was tied directly to India's continued purchases of Russian oil. This is where trade meets geopolitics. India was walking a tightrope, buying discounted Russian crude to manage inflation, trying to stay neutral in the Ukraine conflict, while also depending on the US as its largest export market. Factories in major textile hubs in southern India like Tirupa were under pressure. Margins were evaporating. Orders were slowing. If the tariff stayed at 50%, entire labor-intensive sectors could have faced closures. That's the backdrop. This wasn't a comfortable negotiation. It was a pressure negotiation. Here's what changed with the deal. Tariffs dropped from 50% to around 18%. On paper, that looks like a major win for India. But here's the catch. The 25% punitive component tied to Russian oil? It can come back. At any time. The US has created a monitoring committee, led by the Commerce Secretary, to determine whether India is importing Russian oil directly or indirectly. If Washington isn't satisfied, tariffs snap back. That clause changes everything. Because now Indian exporters aren't just competing on price or quality. They're operating under geopolitical probation. That uncertainty affects contract pricing, supply chains, investment decisions. This isn't just a tariff reduction. It's conditional access. And conditional access is leverage. Now let's talk about the number dominating headlines. The $500 billion. India has committed to spending roughly that amount over 5 years on US military equipment, American energy, including LNG, and high-tech products, including chips and AI infrastructure. That sounds enormous. But here's the nuance. India was already diversifying away from Russian defense hardware, expanding LNG imports with the US, investing aggressively in AI infrastructure. So is this a forced concession? Or is it a redirection of spending that was going to happen anyway? The answer is somewhere in between. Yes, the US benefits. American defense firms, energy exporters, and tech companies all gain. But India also secures supply chains and strengthens strategic ties with Washington. The real question is not whether money will be spent. It's whether India lost autonomy in the process. What was the most politically sensitive part of this deal? Agriculture. The US gains expanded access to India's $580 billion agricultural market, including feed derived from genetically modified corn. Economically, this may not overwhelm India's farm sector. Politically, it's combustible. Indian farmers are one of the most powerful political constituencies in the country. They have a history of mass mobilization, and they are deeply protective of minimum support prices, domestic production, food sovereignty. So Modi made a trade-off. He shielded industrial exporters, avoiding factory closures and layoffs. But he accepted controlled agricultural exposure. That's political risk management, not surrender. So who has the leverage? Now we get to the heart of it. Who actually won? Let's separate short-term from long-term. Short-term. India wins. Why? Export sectors stabilize. Markets avoid panic. The government avoids emergency fiscal spending. Growth momentum continues. This deal prevented an immediate economic shock. But long-term, the United States retains structural leverage because it controls the snapback. It monitors compliance. It ties trade to energy behavior. It institutionalizes conditionality. That's strategic positioning. Trump gets the headline, the $500 billion and India to stop buying Russian oil. But more importantly, Washington gets enforcement discretion. And enforcement discretion is power. Now think about incentives. Trump prefers big numbers, clear narratives, visible American wins. This deal delivers that. Modi prefers stability, growth continuity, strategic balancing between major powers. This deal delivers that too, at least for now. Both leaders can claim victory domestically. But beneath the politics, the agreement subtly narrows India's room for maneuver between Washington and Moscow. That shift won't show up immediately, but it will matter over time. So who won? If you measure victory by avoiding crisis and maintaining strong economic growth, Modi won. If you measure victory by embedding long-term leverage, Trump won. This wasn't an IMF-style bailout. It wasn't a capitulation. It was a stabilization under asymmetric power. India secured breathing room. The United States secured conditional influence. The real test will come later. If the snapback clause is never triggered, this becomes a pragmatic alignment. If it is triggered, this deal will be remembered as the moment trade became a geopolitical enforcement tool. And that, and not the $500 billion headline, is what will decide who truly won.